Phil Muscatello and FinPods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for Beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Chris Batchelor, and we're talking at Redox Limited, ASX code RDX. G'day, Chris.
G'day, Phil. Always a pleasure to be with you.
Thanks very much for coming on and talking about this company. So, this was the largest IPO of 2023. Tell us about the company.
Yeah, indeed. And it's a company that I imagine a lot of listeners wouldn't have heard of. I must admit I hadn't heard of it until it came up on one of my screens and I started looking into it. They IPO'd around July of last year with a market cap of 1.3 billion. So they're a large company and they raised 402 million at that time. Now that's now grown to the point where they're now a $1.8 billion company. So technically still considered a small cap company, but nevertheless getting the larger end of that scale. They're headquartered in Sydney, but they've got over 100 stock locations. Now what they do, they're an importer and distributor of chemicals, ingredients, and raw materials. So all the stuff that most of us use but don't really think about. And their sales are spread across a range of different segments. So things like human health, think vitamins and the like, crop production and protection, industrial, animal health, all the way down to things like mining and explosives and surface coatings. So all those kind of behind the scenes products that are really important to any functioning economy, but they're not really high profile things that most of us think about. Now, effectively what they're doing is they're a middleman. They source goods from over 1,000 suppliers, often internationally, and then they distribute those to their 7,000 odd customers. And those customers are businesses. Hence, they're not a public retail facing company. They're a wholesaler. And the value that they bring is that they source the high quality goods. They manage all the logistics, including all the logistics around importing. They manage the inventory, and then they supply the end customer or the business with the goods that they need.
So this is a family-led company. Who's the family that founded RDX?
Yeah, so they were founded back in 1965, so nearly 60 years ago, by Roland Conigliano. And he was a migrant. Unfortunately, he passed away in 2017, but the share registry is still dominated by the Conigliano family, and they represent around 50% of the shares on issue. Now, the CEO is Raymond Conigliano, and he's the grandson of the founder. And Richard is also the chief operating officer and the largest shareholder, and Renato Conigliano is an executive director. 3 of the 6 board members are members of the family, and then there's a whole list of other family members on the share registry, significant holdings.
How are the interests of shareholders and the family aligned in this case? Because it can be a double-edged sword, can't it, having a family-owned company, can't it?
That's right. So the upside is always that if the business prospers, the family prosper, and so do the other shareholders. So by having such a large equity stake in the business, they're obviously looking to succeed and grow the business, and other shareholders can come along for that ride. Now, the concern when you've got any family-dominated business is that it could potentially be run to the benefit of the family and possibly to the detriment of other shareholders. So you're looking for a situation where the family is running the business and wanting it to succeed, but they're not doing that at the expense of other shareholders. And there are some safeguards here that we can see that are positives. There's no guarantees, but there's certainly some positives that give us some comfort. For example, the chairman of the board is an independent non-executive director, and he's unaligned with the family. None of the family members are on the board's remuneration committee. So that's a key thing that you look for, that they're not just lining their own pockets. And when you look at the salaries of the key family-based executives, they all seem to be quite reasonable given the size of the company. And there's also, within that structure, there's a balance between the short-term and the long-term incentives. So just looking at it, I was reasonably comfortable that the safeguards are in place to make sure that this business is being run for everyone's benefit, not just the family.
Yeah, that's a really important thing to look at in a company, what the long-term, they call them LTIs and STIs, don't they? How these are used to reward directors. That's the case, isn't it?
Yeah, both directors and key executives.
Okay, but in this case, everything looks pretty much in order.
Yeah, that's right. I mean, what you can do, I mean, they look high to the average person, but if you compare them to similar sized businesses, then they're in the right sort of ballpark.
So Redox is an international company. Where does the revenue come from, split between Australia and offshore?
Yeah, so the revenue is dominated in Australia. 85% of their revenue is currently earned in Australia, about 8% in New Zealand, and 7% in the US, with a smattering coming from Malaysia. That said, it is the North American region where they're really focusing their growth efforts. And in fact, last year, North America was the only region to experience revenue growth. They experienced very strong volume growth, 36% volume growth in North America last year, but there was significant price headwinds last year, which we'll talk about in a minute. But nevertheless, they still managed to experience some price growth in North America, and they're really looking to expand their North American footprint.
So when you say price growth, that's what they're able to charge for the products that they're distributing?
Yeah, so there was a lot of pressure last year on pricing. So they grew volumes, but prices came down, which meant that overall revenue actually declined 9.6% last year, and that was due to that pricing pressure. They are largely a price taker, so they have to accept the market prices. What they can control is how they distribute that goods, where they distribute them to their customers, and where they're sourcing the products from.
So let's dig into those costs. I believe that sea freight had a significant impact on the bottom line recently.
Yeah, so anyone who's been following sea freight costs will know that it's been a real roller coaster ride over the last few years.
Oh, it's on my radar every day. I'm checking it every day, Chris.
So any business that's involved in importing or exporting has really been affected by this, because what's happened during COVID, as you might expect, costs of shipping really went sky high. And so that then flowed through to many goods, and that's a big contributor to why we're currently in a high inflation environment. And so they found during COVID that the sea freight costs were accounting for around 10% of their selling costs. Now, during 2023, that stabilized, and when you look at the graph, it really came down dramatically. We're talking like $4,000 for a typical freight, down to around $1,000. So a factor of 4 in terms of reduction. Now, that tracked along nicely towards the latter part of 2023, but then, as everyone will know, conflicts started to erupt in the Middle East, and we started to see ships having to be diverted around that region of the world. And so shipping costs started to rise again. They're not back to COVID levels, but they're still getting quite high. Now, that, of course, is a cost that an importer has to bear, but they are in the fortunate position that they're generally able to pass through those costs to their customers, so it doesn't affect their bottom line too much.
So you mentioned the US as being where the growth opportunities have been pursued recently. Is that the only area that they're looking for these opportunities?
No, they are looking at a wide range of growth opportunities. The US indeed is one of them, and that's the one that they're sort of most actively pursuing. They've just established an entity in Canada to facilitate that North American expansion. However, they are also growing more locally. And in addition to the organic growth, they are also focused on mergers and acquisitions. And they indeed have used their balance sheet. I haven't talked about the balance sheet yet, but they have a very strong balance sheet, and they're using that to fund future acquisitions. In the last year, FY24, they acquired 2 additional businesses, both in ANZ, one called Optigen Ingredients and the other called Element Raw Materials. Now, those names suggest what they might be involved in. And then in July of this year, they acquired another business called Oleum, which is a leading Australian distributor of surfactants and specialty chemicals. And they're currently acquiring a business called Ozchem, and that's expected to complete in the coming quarter, or this quarter now. And that's a leading distributor of solvents and specialty products for mining applications. So as you can see, those 4 acquisitions are all ANZ based. So they are looking to do a lot of expansion and growth here within this region, but they're also targeting M&A possibilities in the US as well as in ANZ.
Do they have a track record with successfully managing these kind of acquisitions?
Yes, that's been a part of their strategy for some time. That's been a major way they've grown this business. So, their success has included that element.
Are you picking shares on gut instinct? Buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB. So you mentioned the balance sheet. Tell us about the balance sheet. Is it a good looker?
Yeah, it is. So the balance sheet's very strong. They have something like $179 million in cash, a lot of that 120 odd million in term deposits, and only around 14 million in borrowing. So basically a very strong balance sheet. Their cash generation is very strong, and their free cash flow is also compares very favorably with their earnings. So when we're looking at a business like this, I mean, it ranks as 93 in terms of its quality in the Stockopedia ranking system. And that reflects that strong balance sheet. It also reflects really good profit margins, high profitability ratios, the good cash generation that we talked about. One of the things that I noted, quite an amazing stat really, is that over the last 30 years, they've grown revenue at a compound annual growth rate of almost 11%. That's quite amazing to be able to achieve that over such a long period of time.
Okay, so you mentioned that the Stockopedia quality rank is high at 93. What does this say about the financials of RDX, apart from the balance sheet and and that compound annual growth that you mentioned?
Yeah, so there's a whole range of factors. I mean, I did say earlier that their revenue actually fell in FY24, but their profits grew, and their profits grew quite well. And that's because they are able to improve their gross profit margin. So in other words, they're able to really manage their product mix and still manage their costs so as to generate profit growth. So that's, obviously contributing. They've got a return on equity of nearly 24%. Now, when we look at other factors like the value rank, that's the lowest of the three factors that we cover, but it's still quite decent at 62. The reason it's a bit lower is the share price has actually risen 37% from the $2.55 float price back in July last year. And that's put pressure on valuation metrics, as you would expect. But, they're still not at excessive levels. And they pay a strong dividend as well. The stated dividend payout ratio is 60 to 80%, and last year they paid out 73%. They're currently trading at a forecast dividend yield of 4%, and that's fully franked. And then the last of those rankings I'll refer to is the momentum ranking, which comes in at 93 at the moment. That's due to that strong share price performance that we talked about. And also analyst expectations have declined a little bit in the last little while. So that's working against the momentum ranking, but it's still nevertheless very strong. And overall, that's giving us a stock rank of 94.
Okay, so I noticed this company's just outside the ASX 200. Is there any chance that it's going to reach that threshold and then get a boost from being included in the ASX 200, do you think?
I think that's a very real chance, yes. Often when companies make it into the ASX 200, they get greater analyst coverage, they get greater institutional money pouring into them, and many of the index funds simply have to acquire businesses that make it into the ASX 200. So yeah, if they can hit that threshold, and then, as you said, they're not far off it, then that will be it's a short-term boost. Ultimately it comes down to the underlying dynamics of the business. But in the short term, that'll certainly help things along, yes.
So what do you think of the outlook for RDX?
Yeah, I think it's positive in a nutshell. They had their AGM on Wednesday of this week, and they revealed that volume growth is already well above historical averages in the first quarter of FY25. They made mention of one new product that they've launched just in this quarter, a sunscreen product, and that's attained sales of $500,000 already in this short period that we've had. They haven't issued any official forecasts. A lot of businesses are conservative about doing that. But they did note that they anticipate volume growth at or above historical averages. And they also believe that price deflation that we talked about, the destocking that's been accompanied with that's largely complete now. So they're expecting more stable price environment. So those are all positives. Turning to what the market analysts are forecasting for the business, and bear in mind there's only 2 analysts that provide coverage for this business at the moment, but they are nevertheless forecasting revenue growth of 9% and earnings per share growth of 6%.
Well, it really speaks to the need for chemicals in our society, doesn't it? Because so many of us are turning to organics and natural products, but chemicals are really here to stay, aren't they, in every facet of life, including sunscreen.
Yeah, that's right. A lot of it's stuff that you don't think about, like you said, sunscreen. I mean, they also do things like vitamins, but it's fertilizer, it's paint, it's, things that mining companies need to use, probably explosives. I don't know the details, but many different products that are sort of behind the scenes, but nevertheless, we rely on them every day.
So, any final thoughts, Chris, on this?
I just thought it was an interesting example of founder-led businesses that can be really attractive. I've invested in a number of founder-led businesses over the years, Nick Scarley, PWR Holdings, ARB. They've all been very successful, and it comes about because you've got a really passionate team of people who have a lot of vested interest in the success of the business. They really pour themselves into it, and as shareholders, we can come along for that ride. And certainly in this case, people who've aligned themselves with the Candeliano family over the last year or so, since the float, they've done very well.
Chris Batchelor, thanks very much for joining me today.
Thanks, Phil. It's always a pleasure.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.